Back in 2008, I remember meeting a man named Raymond at a conference. He was in his mid-60s, modestly dressed, quiet, polite. You'd never guess that this soft-spoken retiree was a multi-millionaire. Not because he built a business, not because he inherited anything, but because in 1985, he read a book about index investing, and he did one simple thing most people never do. He followed the advice. He bought a few ETFs, ones that tracked the total stock market. He reinvested his dividends. He ignored the media. He didn't chase trends. He never tried to time the market. And 30 years later, Raymond wasn't just comfortable in retirement, he was wealthy. That story stuck with me because it revealed a brutal truth about investing simplicity works, and not enough people believe that. Today, we're going to break down 55 of the best ETFs to buy and hold forever. Yes, forever. The kind of funds you could build your entire investment future on. The kind Raymond held. The kind Warren Buffett endorses. The kind that have outperformed 90% of active fund managers. But instead of just reading a list of tickers, I want to go deeper. I want to help you understand why these ETFs work, how they fit into different portfolios, who they're best for, and which ones actually stand the test of time in a world full of hype, speculation, and noise. Because let's face it, we don't just want growth, we want peace of mind, we want control, we want freedom, and these ETFs can get us there. Let's dive in. Every strong portfolio starts with a core, a low-cost, broad-market ETF that gives you diversified exposure to the overall market. These ETFs are your foundation. You'll notice a theme here. The best ETFs are usually boring, and boring makes you rich. VTI Vanguard Total Stock Market ETF. VTI is like owning the entire US economy. Over 4,000 companies, large caps, mid caps, small caps, everything from Apple and Amazon to tiny regional banks and up-and-coming biotech firms. If you want one ETF to rule them all, this is a contender. It has historically delivered around 8 to 10% annually, depending on your holding period. And it's one of the simplest ways to achieve true diversification without overthinking it. VO Vanguard S&P 500 ETF. VO gives you exposure to the 500 largest US companies. It's less volatile than total market funds like VTI because it focuses only on large-cap, established businesses. The S&P 500 has been the benchmark for a reason. Over the past several decades, it's produced reliable, consistent returns. It's not flashy, it's just effective. ITOT is shares core total US stock market ETF. ITOT is BlackRock's version of VTI. It offers nearly identical exposure and performance. Some investors prefer it because of brokerage partnerships or fund structure preferences, but performance-wise, it's a dead heat. SPLG Spider Portfolio S&P 500 ETF. If you want S&P 500 exposure with a rock-bottom fee, SPLG is an underrated option. It's one of the cheapest S&P 500 ETFs available and trades commission-free on many platforms. Great for cost-sensitive investors. Avius, Avantis US Equity ETF. A more recent entrant in the space, Avius is a core equity ETF that tilts slightly toward value and profitability factors. It's actively managed with an academic backbone, and over the last few years, it's delivered performance that edges past traditional market cap-weighted funds. It's easy to fall into the home country bias trap, especially in the US where stocks have performed incredibly well. But the global economy is vast. By investing internationally, you're spreading risk and tapping into opportunities in emerging markets, Europe, Asia, and beyond. VXUS Vanguard Total International Stock ETF. This is the international cousin of VTI. It includes over 7,000 companies from both developed and emerging markets. It excludes US stocks entirely, which is perfect for rounding out a core US-centric portfolio. VEU is similar to VXUS, but tracks a different index. The difference is subtle, but some investors prefer VEU for its country weightings. Both are great tools to get broad non-US exposure. SCHF focuses on developed international markets like Europe and Japan. It's incredibly low cost and great for long-term investors who want non-US exposure without venturing into more volatile emerging markets. Emerging markets can be volatile, but they also offer long-term growth potential. VWO gives you access to China, India, Brazil, and other developing nations that are rapidly modernizing and innovating. IEMG iShares Core, MSCI Emerging Markets ETF. Another emerging markets option with a slightly different index from VWO. It includes small and mid caps, which can add a bit more volatility, but also more growth over the long haul. These ETFs aren't just for retirees. Dividend-focused funds offer stability, cash flow, and often outperform during sideways markets. SCHD has become the gold standard among dividend investors. It focuses on high-quality companies with strong balance sheets and consistent dividend growth. It's beloved for its combination of yield and total return. DGRO takes a slightly different approach by prioritizing companies that grow their dividends. You're getting exposure to companies that reward shareholders and have room to expand. Similar to DGRO, VIG focuses on companies with a history of growing dividends. It has a tilt toward large-cap, financially sound firms and avoids the high-yield traps some other funds fall into. This fund only holds companies that have increased dividends for at least 25 consecutive years. It's a badge of honor and a sign of resilience. Companies in this fund have survived recessions, wars, and market crashes, and still paid investors more each year. Devo Amplify CWP Enhanced Dividend Income ETF. Devo combines high-quality dividend stocks with a tactical covered call overlay. That means you get dividends plus extra income from options. For long-term capital appreciation, growth and innovation sectors can't be ignored. These ETFs give you exposure to future-focused companies in tech, health, and disruptive industries. QQQM Invesco Nasdaq 100 ETF. QQQM is the lower-cost version of QQQ, tracking the Nasdaq 100. That means Apple, Nvidia, Microsoft, and Amazon. It's concentrated and volatile, but powerful over long time frames. VUG Vanguard Growth ETF, a more balanced growth ETF, still tech-heavy, but with exposure to growth-oriented names across multiple sectors, a great complement to core holdings. CEHG Schwab US Large Cap Growth ETF, one of the most affordable growth ETFs on the market, holds a strong tech portfolio but with Schwab's signature low fees and strong tracking. ARK Innovation ETF, a high-risk, high-reward ETF focused on disruptive innovation. Not for everyone, and certainly not for your entire portfolio, but it can offer asymmetric upside for a small allocation. IWF iShares Russell 1000 Growth ETF. It offers a broader set of growth companies than the Nasdaq 100. Slightly more diversified, but still focused on long-term capital appreciation. While broad market ETFs give you diversification, sometimes zooming into a specific sector can supercharge returns if timed right or held with conviction. Here are ETFs focused on major sectors that power the global economy. XLV, Healthcare Select Sector Spider Fund. Healthcare is one of the most recession-resistant sectors out there. People don't stop needing medicine or treatment just because the market dips. XLV gives you exposure to giants like Johnson & Johnson, Pfizer, and United Health. 22. XLF Financial Select Sector Spider Fund. Banks, insurance, credit card companies, and investment firms live here. It's cyclical, but over long periods, financials can provide strong returns as they benefit from rising interest rates and economic growth. 23. XLE Energy Select Sector Spider Fund. Energy has made a big comeback recently, especially as inflation and geopolitical tensions drive oil prices. XLE gives you Exxon, Chevron, and other energy giants with hefty dividends. 24. XLK Technology Select Sector Spider Fund. Tech continues to be the growth engine of the U.S. economy. If you want concentrated exposure to Apple, Microsoft, and semiconductor firms, XLK is a focused way to play it. VNQ Vanguard Real Estate ETF. Real estate is a tangible asset class that generates income through rents and appreciates over time. VNQ gives you a basket of REITs or real estate investment trusts, which can be a powerful income-generating component of your portfolio. While stocks are the growth engine of your portfolio, bonds provide stability and income. They act as a counterbalance during market downturns and are essential for a well-diversified portfolio. BND Vanguard Total Bond Market ETF. BND offers broad exposure to the U.S. investment-grade bond market, including government, corporate, and mortgage-backed securities. It's a cornerstone for conservative investors seeking steady income with minimal volatility. AGG iShares Core U.S. Aggregate Bond ETF. Similar to BND, AGG tracks the Bloomberg U.S. Aggregate Bond Index. It's a go-to for investors wanting comprehensive bond market exposure in a single fund. TLT iShares 20-plus year Treasury Bond ETF. TLT focuses on long-term U.S. Treasury bonds. It's sensitive to interest rate changes, making it suitable for investors anticipating rate declines. LQD iShares iBox Dollar Investment Grade Corporate Bond ETF. LQD provides exposure to high-quality corporate bonds. It's ideal for investors seeking higher yields than government bonds without venturing into high-yield territory. HYG iShares iBox Dollar High Yield Corporate Bond ETF. HYG invests in lower-rated corporate bonds, offering higher yields with increased risk. It's suitable for investors comfortable with credit risk in exchange for higher income. Building a diversified ETF portfolio involves selecting funds that align with your investment goals, risk tolerance, and time horizon. The ETFs listed above offer a range of options across asset classes, sectors, and investment strategies, providing a solid foundation for long-term investing.